Welcome back to Iron Financial. This is the place where we cut through the market noise to help you forge a stronger, more resilient portfolio. I'm your lead analyst, and my job is to follow the numbers, no matter where they lead. And with me is our market skeptic, who's here to make sure we don't get lost in the hype. Today, we are putting National Vision, that's ticker EYE, under the forge. They just released their latest earnings report, and honestly, the numbers are impressive. But here's the puzzle. The market barely flinched. It's that kind of disconnect, that paradox that we live for. So our job today is to figure out if this is a genuinely undervalued, structurally sound company you should be adding to your portfolio, or if it's just a house of cards that's about to get blown over. Let's get to work. So here's how we're going to break this down. We're going to approach this with a blacksmith's precision. First, we'll lay out the central issue, the earnings paradox. Why are fantastic results being met with a collective shrug from investors? Then we're going to start building the bull case, piece by piece, using the hard data from their latest report. After that, I'm handing it over to our skeptic to do what he does best, search for the cracks, examining the company's outlook for the future. From there, we move to the most critical part of our analysis, checking the foundation. We're going deep into the balance sheet to see if this company is truly built to last. And finally, after we've hammered on every single piece of evidence, we will give you our final, unvarnished, iron financial verdict. All right, let's start with the narrative the company wants you to hear. The CEO, Alex Wilkes, is coming out swinging. He's not just saying it was a good year, he's calling it remarkable, a bold reinvention. You know, this is classic corporate storytelling. They're painting a picture of a major strategic pivot, they're targeting more profitable customers, they're tightening the belt on expenses, and ultimately they're expanding their margins. Now, on the surface, this is exactly the kind of confident language you want to hear from the C-suite. It sounds great in a press release, but talk is cheap. Here at Iron Financial, we trade on data, not on carefully crafted narratives. So the real question is, do the numbers actually back up these big claims? Whoa, hold on a second. Remarkable? Bold reinvention? Look, every time I hear corporate buzzwords like that, my skepticism meter just pegs into the red zone. A CEO is paid to be the company's #1 cheerleader, right? But the market tells the truth. And right now, the market is telling us it's not buying what the CEO is selling. Think about it. Despite the incredible numbers we're about to show you, the stock basically went nowhere. It even dipped after the announcement. That right there, that's the paradox we have to solve. If this reinvention is the real deal, why isn't Wall Street throwing a parade? The market smells something, and our job today is to find out exactly what that is. And that is a perfectly fair challenge. The market is always trying to price in the future. I get that. But you can't build a skyscraper on a weak foundation, and you can't accurately predict the future if you don't understand the present. And the present, for National Vision, looks like it's built on a foundation of solid steel. So, for a moment, let's set aside the market's doubts. Let's be technicians. Let's drill down into the hard, cold data from their fourth quarter report. We're going to build this bull case from the ground up, starting with the one number that, by all rights, should have sent this stock flying. Let's start right where it counts, the bottom line. Adjusted earnings per share, or EPS. The company delivered 15 cents. Now, on its own, that number doesn't really tell you a whole lot. 15 cents could be good, it could be bad. But investing doesn't happen in a vacuum, right? It's all about reality versus expectations. And when you put this number up against what the so-called experts on Wall Street were predicting, it becomes the first massive, heavy pillar supporting the entire bull case for this stock. It's a definitive statement about their profitability and their operational discipline that you just can't ignore. And here it is. This is what I'm talking about. Look at this chart. It lays it all out in black and white. Wall Street, with all its fancy models and high-paid analysts, was forecasting 6 cents per share. 6. National Vision walks in and posts 15 cents. Let's be clear, this isn't just a beat. This is an absolute demolition. They didn't just edge out the estimate, they more than doubled it. This is hard, tangible evidence that the company's big strategic moves, their cost-cutting, their pricing changes, that new customer focus, it's not just fluff in a PowerPoint presentation. It is generating real, significant profit that caught the smartest guys in the room completely flat-footed. This is the kind of massive earnings surprise that often signals a true, fundamental turnaround is taking hold. And this wasn't some accounting trick or a one-hit wonder. The entire machine was firing on all cylinders. Just look at these highlights. First, let's talk top-line revenue. It grew by a very healthy 15%, hitting over $500 million for the quarter. Strong. But now, look at where the real story is. Profitability. Adjusted operating income, it exploded by almost 450%. And no, that is not a typo. 444.8%. That shows incredible operating leverage. As revenue grew, profits grew exponentially faster. And that profit surge directly fueled a massive expansion in their operating margin from a razor-thin 0.7% last year to a much, much healthier 3.5% this year. To cap it all off, their comparable store sales, a key metric in retail, grew by a robust 6.6%. This isn't just one strong number. It's an entire operational fortress. Now, you might be thinking, okay, great quarter, but maybe it was just a holiday season fluke, right? A fair question. So let's zoom out and look at how this performance played out across the entire year. The full year numbers confirm that this isn't a one-time event. It's a sustained trend. Net revenue for the full year climbed 9%, getting really close to that $2 billion mark. Adjusted operating income surged by over 56%. And the big one, adjusted EPS for the year jumped nearly 54%, from 52 cents all the way up to 80 cents. This is the data that validates the CEO's claim of a bold reinvention. So the bull argument is pretty straightforward. This isn't just one strong quarter. It's the capstone on a transformative year of heavy lifting, smart decisions, and most importantly, successful execution. Okay, impressive. I'll give you that. The rearview mirror is absolutely spotless. The structure they built in 2025 is solid. I won't argue that point. But you and I both know we don't make money by investing in the past. We forge portfolios that are built for the future. And the second you stop looking at where this company has been and you start looking at where it says it's going, that's when some really serious cracks start to appear in this beautiful facade. The market isn't ignoring the great Q4. No, it's looking past it and reacting to the very cautious guidance for 2026. And that, my friend, is where the whole bull case starts to crumble. Exactly. This slide tells the whole story, doesn't it? It's the tale of two completely different companies. On the left, you've got this high-octane, explosive performance from late 2025. Massive beats, expanding margins, strong sales, everything an investor could ever want to see. But then you look at the right side, and this is, in my opinion, this is the company's own forecast for 2026, and it's lukewarm at best. The guidance they've laid out points to a major slowdown, a significant deceleration in pretty much every key metric they just finished bragging about. So the billion-dollar question becomes, was 2025 a real, sustainable reinvention that set a new, higher baseline for growth, or was it just a one-time sugar high that's about to wear off? That cautious outlook is exactly what's giving investors pause. Let's look at the actual numbers they gave us, because this is where the cracks really show. Comparable store sales growth, which, remember, just hit a strong 6.6%, is now guided for a range of 3 to 6%. Best case, it's a slowdown. Worst case, it gets cut in half. That's a potential slowdown at the most fundamental level, the store. Then there's net revenue. Their guidance right at the midpoint is barely above what analysts were already predicting anyway. No big surprise there. And then the EPS. They're guiding to between 85 cents and $1.09. Now, yes, technically that is growth over the 80 cents they just posted. But after a year where EPS grew by 54%, a rocket ship, the midpoint of their new guidance represents about 20% growth. That is a massive step down. The question the market is wrestling with is this it? Have we already seen the best of this transformation? And hey, don't just take my word for it. Look at the professionals, the folks on Wall Street who get paid to analyze this stuff all day. While the official consensus rating is a moderate buy, that term is hiding a lot of disagreement. Sure, you have 8 analysts in the buy camp, but look deeper. You have 4 sitting on the fence with a hold rating. And we all know a hold is often just a polite way of saying, we're not confident enough to tell you to buy this thing. Most telling of all, you have 1 analyst with an outright sell rating. That's a huge red flag. This is not the picture of a happy, unified, confident analyst community. It's a picture of deep division and skepticism. And that tells me I'm not the only one who sees the fantastic past, but is deeply concerned about the very uncertain future. Okay, so the battle lines are drawn. We have a stellar, proven past going up against a cautious, uncertain future. In any investment, performance and outlook are like the top floors of the building. They're what everyone sees. But to truly judge the integrity of a company, to know if it can withstand a storm, we have to go down to the bedrock. We need to check the foundation, the balance sheet. This is where the numbers don't lie. This is where a company's true strength, or its fatal weakness, is revealed, far away from the quarterly narratives and optimistic forecasts. So, is this company built to withstand a potential slowdown, or is it overleveraged and at risk? And the foundation here is pure granite. Step 1, leverage. Let's look at their debt-to-equity ratio. It's just 0.28. In today's market, that is exceptionally low. This company is not drowning in debt. Step 2, liquidity. They have a $300 million revolving credit facility. And guess how much they've drawn from it? Zero. Not a single dollar. That means they have ample access to cash if they need it. And step 3, this is a huge signal of management's own confidence. They just authorized a brand new $50 million share buyback program. That's management putting their money where their mouth is. Or is it? A skeptic sees that buyback and asks a very different question. Is it a genuine signal of strength and confidence in the future? Or is it a convenient tool to prop up a sagging stock price when you know your forward guidance is weak? It can be a way to put a floor under the share price and make sure executive stock options pay out, even if the real operational momentum is starting to fade. It could be financial engineering, not fundamental strength. A very healthy debate. We have two powerful, competing narratives, and both are supported by the data. So now, this is what it all comes down to. With the bull case and the bear case laid bare, it's time for the iron financial verdict. We've examined the structure from every angle. We've hammered on it to find the potential cracks, and we've pressure tested the foundation. Now we have to weigh all of this evidence and make a call. Is National Vision a solid opportunity to strengthen your portfolio, or is it a carefully disguised trap waiting to spring? So let's summarize the bull case one last time, plain and simple. It is rooted entirely in proven historical performance. First, a decisive, unambiguous fourth-quarter earnings beat that absolutely crushed expectations. Second, this wasn't a fluke. It was the final proof point of a full-year operational turnaround that showed consistent, measurable improvement. Third, the engines of that turnaround are crystal clear: strong margin expansion and healthy sales growth, all fueled by a successful strategic pivot. And finally, and maybe most importantly, all of this is built on top of a rock-solid, clean balance sheet with very low debt and tons of liquidity. The bulls see a healthy, well-run, disciplined company that has proven it knows how to execute. And the bear case? It all boils down to one word: next. What happens next? First, the company's own forward guidance signals a clear and significant slowdown in growth. It's not a guess, it's what they told us. Second, the market doesn't pay you for yesterday's victories. It pays for the promise of tomorrow's growth. And right now, it is pricing in that future uncertainty. Third, this raises very legitimate questions about sustainability. Was 2025 the peak? Was that the best they can do? And finally, the divided analyst community is proof that these concerns are shared by plenty of other professionals. The bears see a company whose best days of growth might already be in the rearview mirror. So there you have it. Proven execution versus future uncertainty. A fortress balance sheet versus a questionable growth path. It's time to cut through all the complexity, weigh the facts on the scale, and deliver one unified, actionable takeaway. It is time for the iron financial verdict. After weighing all the evidence, hammering on both sides of the argument, Iron Financial's verdict is this: National Vision is a cautious buy. Let me be clear, this is not a market trap. The operational turnaround we saw in 2025 is absolutely real. The numbers are undeniable. And that fortress-like balance sheet provides a huge margin of safety that should limit your downside risk. However, the bear case is valid. The slowdown implied by their 2026 guidance is a real headwind, and it completely justifies the market's hesitation. In fact, we believe the current stock price has already absorbed that negative news. The conservative guidance is likely already priced in. This is what creates an attractive entry point for investors with a longer time horizon. People who can buy now and patiently wait for the story to play out. For those of you looking for more of a short-term catalyst, the thesis is simple: wait for proof. The company must now prove that the 2025 reinvention has legs. If, in the coming quarters, they can meet and, more importantly, beat the high end of their own 2026 guidance, it will be the signal that this turnaround is sustainable. That would likely force the market to reevaluate the stock and price it higher. So the final question you have to ask yourself is this: do you believe management is sandbagging, setting a low bar they can easily clear? Or have they truly hit a growth ceiling? For patient investors who believe in the execution, we believe the risk-reward profile here is favorable.
Quick disclaimer: everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.